stocks made a slight upward move, bringing a halt to a 4-day decline, as concerns over interest rates and the possibility of a government shutdown were balanced by renewed optimism in the field of artificial intelligence. AMC, famously known for the stock that generated numerous internet memes, saw an almost 7% increase following the Writers Guild of America's tentative agreement with Hollywood studios. This agreement reassured investors that there would be new movies available for theaters in the coming year. In other news, Moody's, the lone major credit rating agency still granting the U.S. government a AAA rating, issued a warning that a federal government shutdown would have adverse effects on the country's credit. Despite the drama with the U.S. credit system, artificial intelligence, a trend that took center stage nearly a year ago, continues to offer attractive opportunities for investors, so here are some of the best AI stocks to buy. Analyst William Stein reaffirmed his buy ratings for Nvidia and monolithic power systems, while also reiterating his price targets of $668 for Nvidia and $600 for monolithic power. As a comparison, in Tuesday's trading session, Nvidia stock experienced a 0.9% increase, reaching $425.82, while monolithic power shares saw a 0.5% decline, settling at $451.04. Stein's confidence in Nvidia stems from its chips being the preferred choice among engineers for building AI systems. He believes the company is well suited to handle a majority of AI workloads, especially in the training of new models. Stein anticipates that Nvidia will see growth in its data center revenue over the next few years due to the rising demand for AI servers. He cited Nvidia's assertion that the $1 trillion worth of hardware in data centers needs replacement every 4 years, with a growing focus on AI infrastructure. Additionally, he expressed confidence in Nvidia's sustainable leadership in both the gaming and future autonomous driving markets. Stein also expressed optimism regarding the demand for AI in monolithic power, a company specializing in power management semiconductors. Monolithic Power's exposure to AI spans various sectors, including cloud computing, industrial applications, and communications. Stein anticipates that the company will expand its offerings to include more comprehensive technology solutions alongside its chips, resulting in increased revenue and improved profitability. For EV stock news, we see that Rivian Automotive is aiming to challenge established players like Tesla, Ford, and General Motors with its adventure-themed electric vehicles, to where analysts are now predicting that Rivian may surpass third-quarter delivery estimates. Rivian is expected to announce its third-quarter vehicle deliveries in the coming days. In 2022, the company reported third-quarter production and deliveries on October 3rd, with analysts estimating Rivian Q3 deliveries at 14,000 units, according to FactSet. In comparison, Rivian delivered 6,584 units in Q3 of the previous year. On September 26th, Baird analyst Ben Kallo designated Rivian stock as a bullish, fresh pick in anticipation of better-than-expected third-quarter deliveries. Kallo cited expectations that Rivian would outperform consensus views due to cost benefits from an improving supply chain and in-house component usage. Rivian, headquartered in Irvine, California, has experienced a roller coaster ride since its initial public offering 2 years ago, influenced by market conditions and execution challenges. Like the broader automotive industry, Rivian has faced supply chain disruptions and its own operational issues, including product recalls and temporary price increases. Profitability for Rivian is not expected in the immediate future as it continues to scale up production. However, the company did report better-than-expected second-quarter earnings and sales. In its second-quarter results, Rivian reported an adjusted loss of $1.08 per share, with revenue nearly tripling to $1.12 billion. Analysts, including longtime Tesla bull Dan Ives of Wedbush, saw this as a significant step in the right direction for Rivian, with strong demand and improved visibility through 2024. UBS initiated coverage of Rivian stock with a neutral rating and a $26 price target on September 12th, anticipating positive gross margins by 2024. However, substantial production volumes are not expected until later in the decade, requiring additional capital to support growth. Rivian has exceeded expectations in its second-quarter delivery report, delivering 12,640 vehicles in Q2, surpassing Wall Street estimates. The company also raised its full-year production guidance to 52,000 vehicles, nearly doubling the previous year's production. Rivian produces electric pickup trucks, SUVs, and commercial vans in its Normal, Illinois plant, with a production capacity of 150,000 units annually. The company has encountered challenges in achieving its production goals, with the global semiconductor chip shortage and rising costs of key materials hindering its efforts. Rivian is counting on increasing production as its primary path to profitability and anticipates achieving its first gross profit in 2024. For fiscal 2023, Rivian expects adjusted earnings before interest, taxes, depreciation, and amortization to incur a $4.2 billion loss. The company has also adjusted its capital expenditure forecast for 2023 to $1.7 billion, down from the initial guidance of $2 billion. In June 2023, Rivian announced a deal to utilize Tesla's supercharging stations starting in 2024, following similar agreements made by Ford, General Motors, and other automakers with Tesla. In other news, Draftkings has seen a disparity between its stock price performance and its on-field success. JP Morgan recently upgraded the online gambling operator from neutral to overweight, raising its price target from $26 to $37 per share, as it believes Draftkings stock has underperformed compared to the S&P since July. Analyst Joseph Greff justified the upgrade by noting Draftkings' appeal within the sector, with strong growth prospects in existing and new markets. This comes amid an industry-wide improvement in operating expense control, partly due to a decreasing percentage of revenues originating from newer markets, which typically involve higher user acquisition costs and upfront investments. Draftkings witnessed a substantial increase of over 175% in its stock price through July, driven by market share gains and optimistic outlooks from Wall Street. JP Morgan's analysis demonstrated that Draftkings increased its gross gaming revenue market share from 28% in the first quarter to 32% in the second quarter, compared to just 20% during the same period the previous year. Draftkings also saw improvements in its hold rates, which represent the percentage of money retained by the company from total customer bets. This improvement resulted from enhanced accuracy in odds making and customer transitions toward more profitable betting options. JP Morgan anticipates further declines in customer acquisition costs as Draftkings achieves national scale and as sales and marketing expenses decrease. Draftkings has projected its first full year of profitability for 2024, although concerns had arisen due to the entry of major new competitors into the market just before the crucial football season. Speaking about the competition, you should also know that back in August, Penn Entertainment ended its partnership with Barstool Sports and signed a $2 billion agreement with ESPN to launch ESPN Bet, which will be launched in November. Penn aims to increase its market share substantially, competing with Draftkings. Additionally, e-commerce giant Fanatics recently introduced its own sportsbook, led by former FanDuel CEO Matt King. Despite these developments, JP Morgan believes that Draftkings has a strong competitive position, characterized by its product, scale, and brand, enabling it to contend with new entrants like Penn's ESPN Bet and Fanatics, as it previously did with Caesars. In summary, the financial landscape is experiencing a delicate balance of factors that impact various sectors. Stocks recently showed a modest recovery from a 4-day decline, with optimism in the realm of artificial intelligence offsetting concerns over interest rates and a potential government shutdown. AMC, the iconic meme stock, surged following an agreement between the Writers Guild of America and Hollywood studios, promising new movie releases. At the same time, Moody's, while maintaining a AAA rating for U.S. credit, still cautions about the consequences of a government shutdown. Meanwhile, investors continue to find promising opportunities in the artificial intelligence sector, as highlighted by Truist Securities. Analyst William Stein's bullish outlook for Nvidia and monolithic power systems underscores the significance of AI in the tech industry. All while Rivian is poised to challenge established giants like Tesla, Ford, and General Motors. Analysts anticipate a strong performance in Rivian's upcoming third-quarter delivery report, marking a significant step toward profitability. This is due to Rivian's ambitious production targets and strategic partnerships, including access to Tesla's supercharging stations, highlighting its determination to carve a niche in the EV market. Lastly, Draftkings, the online gambling operator, has seen a stock performance that lags behind its industry success. JP Morgan's upgrade reflects the belief that Draftkings stock has not kept pace with its promising market share gains. The company's ability to maintain a strong position amid new competitors, such as ESPN Bet and Fanatics, underscores its resilience in the evolving landscape of sports betting. In this ever-changing financial environment, careful analysis and strategic decision-making will be essential for investors and businesses alike. The interplay of factors like AI trends, EV innovation, and the dynamics of the online gambling industry will continue to shape the future of the financial markets. With all that said, I wish you happy investing.